perpetuating the problem.
I get what you're saying. It's a debate that's going on in India as well. Interestingly, because our business environment is so driven by families and individuals and the promoter culture, this conversation about the separation of the role of the chairman and the managing director, the lead director, or the CEO, as you all call it, has been one that has occupied Indian companies. Many of them were very against that separation, saying you are now building in, all kinds of sort of chains and locks into how an individual can function. But it is a governance conversation. One of the more interesting things that came up in the public domain in the last month or two has been this conversation around short-term investors and whether they should have the same kind of voting rights as longer-term investors should. A lot of it was sort of commented upon in the context of the Cadbury Kraft takeover. What is popular opinion on this matter in America? Do you think regulators are looking at this in any serious fashion?
I would say it's certainly a topic of debate, but more so probably in the academy than elsewhere. In other words, look, it's perfectly obvious that there's a lot of distortion that takes place in the market through investors, sometimes not only with short-term interests, but sometimes even with, they may have a short position even. They may have a negative interest. There's not an alignment between the financial interests arrayed around a company and the long-term success of that company. You have the very famous CDS, credit default swaps, that existed. You had all kinds of concerns, particularly during the financial crisis, and particularly around financial companies, that their shares and their debt both were subject to manipulation through all kinds of different instruments and complicated derivatives and hedging and trading strategies that actually interfere with their ability to continue to exist and prosper. So there's no question that the stable, long-term shareholder of years past is a thing of the past. I mean, if you look at the big mutual funds and the big pension funds and big endowments and so forth, if you look at the part of their portfolio that's held in publicly traded stocks, it's literally hundreds and sometimes thousands of names, as they're called, which means different companies.
Yes.
And the turnover can be easily 100% a year. So, to me, again, it's perfectly logical to say that there should be some insulation between the feeling of the moment that investors have and the ability of a company to chart a long-term course.
What kind of insulation?
Well, again, it's an interesting question. So, for instance, I would certainly say having a staggered board where you couldn't be subject to a change of control on an annual basis, or having the ability only to call a special meeting or to change the directors on an annual basis isn't a terrible thing. The rhetoric in the States has generally been of investor rights, and so the point to where it's been taken is that if a majority of shareholders at any time should want to change the board or change the direction of the company, that should be their privilege, because after all, they own a majority of the shares. And that actually is not really the paradigm of the corporation, which has gone on since the 17th century when corporations were first invented in England and in Holland. The paradigm is that people are in a venture together, and they select managers, and they make a delegation to the managers for a purpose. I mean, the original corporations were all purpose corporations, whether it's the British East India Company or the Dutch East India Company, or whether it's some of the companies that were formed in connection with the colonization of America. They all had a specific purpose, and people went into them effectively for their term. Now, we have corporations now which have unlimited term, but they still are autonomous. They are an enterprise, and no one knows them and understands them as well as the people who've made the largest investment in them, which are the managers who put their whole career into a company. So I don't have a problem with the idea that those managers should be insulated from removal at any moment by a mere majority of people who happen to be shareholders of the company at that particular moment. I don't think that it's all sort of circular in a way, because the question is if we all decide that's exactly what the rule should be, well, that's what it is then.
Right.
So you can't prove it by reference to what the nature of a shareholder is. But if you look at corporations more broadly, managers and workers have a huge investment in the company. The communities in which they operate have a huge investment. Society as a whole has a huge investment in the success of corporations. Shareholders are one very, very important group that has a great interest in the success of a corporation.
But they're not the only group.
But they're not the only group, and it's not a possession. Like if I own this suit, I can do what I want with it. I could sell it, I could keep it, it's mine.
Right.
Owning 50% of a widely held public company, which you may have acquired the day before and may well sell the day after, which represents 1/100th of your portfolio or 1/1000th of your portfolio, is not the same as owning a suit. And it shouldn't be as easy for a shareholder to direct what happens with the corporation as it is for me to sell my suit.
It's interesting you say that. One of the key elements of that debate has been what the Cadbury chairman seemed to have suggested, which is that those shareholders that end up buying the stock after an offer has been made, maybe they should have restricted voting rights. A lot of this leading into the debate saying, should shorter-term shareholders or shareholders who are in it or investors who are in it for the shorter term have fewer or lesser voting rights? But how are you ever going to, I mean, there's no way to put this into a set of rules, right? Because how do you determine who is necessarily going to be long-term, who definitely is short-term, therefore he deserves better voting rights or stronger, higher voting rights, but she doesn't deserve them? I mean, those are difficult things to put into rules. This will continue to only be an academic debate, right?
Well, there are, for instance, there's a debate going on right now in Spain where effectively most companies, a person generally can't acquire more than 10% of the voting rights of a public company in Spain.
Okay.
And so the people who believe in a greater market for corporate control, and that includes me in many senses. I mean, I went to the University of Chicago and studied with all these free marketers and so forth. Right. Say this is bad because basically, even if someone comes along and buys 30% of a company in Spain and holds it for 10 years, they still may be limited to 10% of the votes, and they may be subject to the Spanish equivalent of a promoter, and it's disproportionate. And so I would say probably the people who are criticizing the Spanish regime currently are basically right, saying that no matter how long you own your stake, you're limited to 10% of the votes is probably the wrong answer. That's too little democracy. It's too little power to go with your economic ownership of a corporation.
Right.
Whether or not any time-phased or scaled voting system is equally suspect, again, I'm not so sure that's right. So let's say you had a system where you couldn't have more than 10% of the votes except if you held the shares for a year. That doesn't sound so terrible to me. Obviously, you can concoct sort of hypothetical examples in all of these cases where you can imagine some injustice or unreasonable results. So if there are people who are bad people who are running a corporation and the shareholders have a desperate need to get rid of them because they're looting or they're asleep at the switch, and yet they don't have any votes, how could that be right? What if all the shares turned over in a quick succession and someone who only had a little bit ended up with all the votes? I mean, you have to think very carefully about how all these systems would work. One of the big things we have in the States, most of the major American companies are incorporated in the state of Delaware. Very small state, but which happen to develop great expertise in corporate law and in regulating corporations. There's a very specialized court there, the Court of Chancery. Just a few chancellors and one chancellor and a few vice chancellors on this court. They hear literally dozens, hundreds of corporate law cases, and they're very, very effective police officers, effectively. So there is a mechanism in the states, including for public companies, where if someone is looting or stealing or doing something, very wrong, can be brought before a court. It's not like a routine part of the system where you petition the court for a review of corporate action, but there is a framework of duty that binds officers and directors of Delaware companies, which is subject to judicial review. So again, we have, like most places, a long-established, very complicated system with a lot of different checks and balances in it, which, again, in my view, we should tinker with very gingerly, lest we end up creating more problems than we solve.
It's worked for that many hundred years, as you keep
Well,
pointing out.
It's worked for a while.
Right?
It's worked for a while.